Hej Magnus, det är en supersnabb grej bara. Visst var det så att kung för en dag från början skulle...
Hi everybody, I really like being on this side, so I'm just going to stay here for a bit. And this video is going to look at the disadvantages, the problems of imposing a tariff specifically. In truth, a lot of these arguments are quite generic to the issues of protectionism, so don't think these are just confined points for a tariff. They are points you can use generally on any protectionism-based essay, and they're very, very strong. There aren't many of them, but every single point here is a seriously strong point, carries great weight. Okay, so if you can analyse these well, plenty, it's all you need to score very high marks on an essay that came up. So you've got your theory on the one hand, you know what the intentions of a tariff are, you know how a tariff works, the impact it has on a diagram, how to analyse it, you know the arguments for using a tariff, good, but that's only half the essay, right? This is the flip side. So again, here's your tariff diagram, it's such a wonderful, beautiful, useful diagram. It's just magic on axis right here, okay? So this diagram also gives you a lot of the key points you need on the other hand, such as number one, how a tariff distorts the market. You know, free marketeers would hate tariffs, messing around with what was once a very efficient allocation of resources, a market that was doing a pretty damn good job at satisfying as many people and stakeholders as possible. Whereas now, especially on consumers, there is a very detrimental effect. Have a look. The price has increased, doesn't it? From PW to PW plus T. With that higher price comes a loss of consumer surplus. More specifically, there is a deadweight welfare loss of consumer surplus. Horrible news for consumers. They are hindered quite massively as a result of this tariff. Not just because of the higher price, but also a loss of consumer choice. Look at the quantities in the market. Previously, they were consuming Q2, some of which was being supplied by domestic supplies, some of which was being supplied by world supplies through imports. But they were getting a huge amount of choice there, whatever market this was. They could have picked to buy from domestic supplies, they could have picked something more exotic from abroad, they could have picked something they thought more reliable or higher quality from abroad. They had that choice to make. Now, the kind of choice they have is much less. Only Q4 is the actual quantity coming into the market. So there is a loss of consumer choice as quantity in the market is falling. Okay, so consumers are hurt two ways, and you can really analyse this point. With a loss of consumer surplus from a higher price, a deadweight loss right there, and a loss of consumer choice, and then satisfaction happens, all that kind of good stuff has been lost. There are also production inefficiencies. So as an economist, which you all are, top economists, right? This is a big point to make, because what is economics about? It's all about the efficient allocation of resources. If through this policy, the allocation of resources has worsened, we have a significant problem here. And we know that this left triangle represents a deadweight welfare loss, a loss of world efficiency gains. So if you want to call it allocative inefficiency, you can do, because that's pretty much exactly what it is. Domestic supplies producing those extra units of quantity is wasteful. They need a higher price in order to produce those because they're less efficient. Right? They produce them at higher cost compared to world suppliers. That's inefficient. They shouldn't be planning resources there. Those resources should be used by world suppliers instead. So those production inefficiencies
I go B with Al Capone.
worsen the allocation of resources.
I go be with dinosaur.
Заебал, что на русском нахуй разговаривать будешь?
Number three is a really strong point. If you as a nation, as a government, decide to impose a tariff on certain imports coming in, whatever it might be, clothing, wheat, foodstuffs, tobacco, whatever it might be, you can expect retaliation coming from the nation on which you've imposed this tariff. Okay? And you can expect that retaliation to be much stronger. So if you put a tariff on, I don't know, 10% on certain goods coming in from a given nation, you can expect much worse retaliation. And retaliation is awful. Retaliation just hurts consumers more. Retaliation makes its inefficiencies worse. Retaliation is not good for anybody, really. And it distorts the real benefits that can be gained from free trade. Okay? So retaliation, on the one hand, you might see some benefits of imposing this tariff, but if the nation retaliates on you, then the cost of that retaliation will be much higher than the benefits that may have accrued from this tariff. And tariffs are regressive. Okay, who bears the burden of the tariff? It's consumers. Okay, and a lot of tariffs go on low-priced items or essential items that the poor or those on low incomes tend to buy a lot. Clothing is a good example. Agriculture-based products, your typical foodstuffs, your fruit and vegetables, your meat, that kind of thing. Clothing, all these kind of basic items that low-income households tend to spend the majority of their income on. They are the ones who are going to suffer. So in that sense, a tariff is regressive. It hurts those on low incomes far more than will hurt those on high incomes. So when it comes to equity and the distribution of income, imposing a tariff is likely to worsen the distribution of income and worsen the issue of equity. When it comes to evaluation, what kind of things can you talk about? Well, you can always question the size of the tariff and therefore the impact it's going to have on the market. You can also question the elasticity of demand and supply in this market here. So remember, the intention of the tariff is to squeeze imports, to reduce the quantity of imports coming into a country. Well, if demand and supply are both very inelastic for various reasons, then actually the quantity, the extension of supply for domestic suppliers will increase, but not by very much. The contraction of demand, okay, yes, there'll be a fall, but not by very much. Therefore, the fall in imports coming into the country will be quite minute, will be quite small. So if ever you're questioning your end impacts of a tariff, you can always bring in the elasticity of demand and supply, especially if the two are very inelastic. You'll see, if you put them on a diagram, how the quantity of imports does not fall by a great level. That's a nice evaluation point alongside the size of the tariff, which is also substantial in understanding the actual impact it will have on the market. Okay, so that's it for tariff, guys. Really important set of 3 videos I made on the tariff. Make sure you learn it all and you're happy. It's a very common exam question, so hopefully now you feel confident to nail it and that you know all the points for it. Thanks so much for watching. I'll go back to that side, I think, on the next video. Alright, see you then. Thank you.
Vi hjälper dig att få hem precis som du vill.
Hi everybody. We've understood how a tariff works. Let's now understand how an import quota works. We know what a quota is. It's a quantity limit placed on the number of imports coming into a country. Let's analyze how a quota impacts on a market. So again, we started with free trade, always a good starting point for these protectionism diagrams. Q1 is a domestic supply at the price PW. Q2 is a domestic demand at the price PW. We're all happy with that. Let's now assume that an import quota was put in place by the government. Okay? And let's say that quota was set at Q3. So previously, Q1, Q2, the difference between the two, the number of imports coming into the country, that was the excess demand. Now, the government is saying now, only up to Q3 are the level of imports allowed. So before Q1, Q2 imports, now only Q1, Q3. So the level of imports, quantity of imports, is now capped at Q1, Q3 only. Okay, what does that do? It leaves an excess demand, doesn't it, of Q3 and Q2. And normally excess demands and free trade will be satisfied by imports, but we can't anymore, because as a nation we've already hit our quota. We can't import anything beyond Q3. So what happens? Well, now there is an excess demand, that puts a lot of pressure on the price. That leads to an increase in price in the market, and it pushes up the price. Okay, so on a diagram, what you need to do, you pick your quantity value, you pick your quota value, you then go up to the domestic supply curve, and you go across. Okay, so that level there is the new price, or that PW plus quota. Okay, so the new price is hit there, and at that new price, new suppliers enter the market. They're incentivized by the higher price. We have more domestic suppliers that come in. So what you need to make sure you do now is connect these 2 points together to show a shift of supply. Okay, so we'll call that SD with the quota, and that comes about through the incentives of the price mechanism. Alright? So it means that domestic suppliers now supply up to Q4, and there is a contraction of demand. Okay. So, let's now analyze this diagram. So with this higher price, because of the excess demand needing to be rationed, what's going on? Well, domestic suppliers have increased their supply. They were just supplying Q1, but now they're supplying Q1, but they're also supplying the difference between Q3 and Q4. That's the new addition now. What's happened to domestic demand? Domestic demand has contracted from Q2 to Q4 because of this higher price. Okay, what does that do? It leaves impacts on a market. So again, we started with free trade, always a good starting point for these protectionism diagrams. Q1 is a domestic supply at the price PW, Q2 is a domestic demand at the price PW, we're all happy with that. Let's now assume that an import quota was put in place by the government. Okay? And let's say that quota was set at, call it Q3. So previously, Q1, Q2, the difference between the two, the number of imports coming into the country, that was the excess demand. Now, the government is saying now, only up to Q3 are the level of imports allowed. So before Q1, Q2 imports, now only Q1, Q3. So the level of imports, quantity of imports, is now capped at Q1, Q3 only. Okay, what does that do? It leaves an excess demand, doesn't it, of Q3 and Q2. And normally excess demands and free trade will be satisfied by imports, but we can't anymore because as a nation we've already hit our quota. We can't import anything beyond Q3. So what happens? Well, now there is an excess demand, that puts a lot of pressure on the price. That leads to an increase in price in the market, and it pushes up the price. Okay, so on a diagram, what you need to do, you pick your quantity value, you pick your quota value, you then go up to the domestic supply curve, and you go across. Okay, so that level there is the new price. Call that PW plus quota. Okay, so the new price is hit there, and at that new price, new suppliers enter the market. They're incentivized by the higher price. We have more domestic suppliers that come in. So what you need to make sure you do now is connect these 2 points together to show a shift of supply. Okay, so we'll call that SD with the quota, and that comes about through the incentives of the price mechanism. Alright? So it means that domestic suppliers now supply up to Q4, and there is a contraction of demand. Okay? So, let's now analyze this diagram. So with this higher price, because of the excess demand needing to be rationed, what's going on? Well, domestic suppliers have increased their supply. They were just supplying Q1, but now they're supplying Q1, but they're also supplying the difference between Q3 and Q4. That's the new addition now. What's happened to domestic demand? Domestic demand has contracted from Q2 to Q4 because of this higher price, and less consumer demand coming in. What about efficiencies and consumer surplus losses? Well, because there is a price increase, there is a deadweight loss again of consumer surplus. It works in exactly the same way as it did with the tariff diagram, so it's the same triangle. That is a deadweight welfare loss of consumer surplus. Again, you can work out the different consumer surplus areas, and you realise it's very much the same as it was with the tariff. Okay, and that is the deadweight loss, the unrecovered loss. There is also a loss of world efficiency here, and that loss of world efficiency comes from the extra units that domestic suppliers are producing that they shouldn't be producing because they're inefficient compared to foreign producers who have the comparative advantage. So that there, that triangle, is a deadweight loss of efficiency, let's just call it that. Okay, so that's a deadweight welfare loss, a loss of efficiency, as domestic suppliers are producing at a higher cost. Remember, supply tells you the marginal cost. They're supplying these units at a higher cost than what it would have cost world suppliers. They need more resources. They need a greater price, a greater cost to produce these units compared to world suppliers who are way more efficient, who have the comparative advantage here. So that is a quota diagram. Again, I'm going to make one more video which dissects this diagram in crazy detail, which gives you everything you need to know. So if you want to understand this more in detail, watch that next video to gain full understanding of it. But what you need to take away from this, that's all you need to draw in an exam. The impact on domestic demand, on domestic supply, on imports and on price, and then finally the impacts on efficiency and consumer surplus. That's all you need to take away and you'll be fine. We then look at the arguments, okay, for protectionism. Like I did with tariff, we can apply these to the diagram again. The argument of protecting infant industries and letting them grow. Well, we've increased the production for domestic supplies, haven't we? From Q1 to Q3, well, still Q1, but Q1 plus Q3, Q4 is being supplied domestically, so there's an increase in production there, maybe allowing these firms to benefit from more economies of scale. The dumping argument, selling below cost of production, well, now with this higher price for imports coming in, you're negating some of that dumping effect. Protecting domestic employment, again, with more domestic supply, we can expect employment to, at worst, stay the same, but most likely increase. Low-cost labour, if that's an argument to protect against low-cost labour, and the artificial advantage that comes from that, well, again, with a higher price, you kind of dampen that argument, and you dampen the advantage that comes from it. And maybe the protectionism is used to improve the current account position. Well, obviously here, imports are being heavily restricted, so you'd hope that import expenditure would decrease enough to improve a nation's current account position. Keep your eye out for the next video. We'll go through this in more detail. Thanks very much for watching. See you next time.
Hej Magnus! Du, en supersnabb grej bara. Visst var det så att kung för en dag från början skulle handla om tjänstepension?
Hi everybody, I'm really not learning. I mean, blooming same mistake as last time with the diagram in the wrong place. It doesn't matter. So I'm back on this side again. Let's do another detailed analysis of the impact of a quota on a market. Okay? It's unlikely we'll have to draw this diagram, but just in case it's useful, again, to be able to analyse it just like a tariff diagram. Let's get moving. Start with price. What's happened to the price as a result of this quota? You'll see it's increased. So the price has gone up. PW to PW plus Q. Increase in price. What's happened to domestic demand? Because the price has gone up, domestic demand has contracted. So that's gone down initially from reduction, a contraction in domestic demand. Domestic supply has increased. Yeah, has increased. So initially it was Q1. Now, still supplying Q1 units, but they're also supplying Q3, Q4. So to Q1 plus Q3, Q4. Alright. The level of imports has been capped, so imports have fallen. That's the idea, isn't it? From Q1, Q2, initially, to just Q1, Q3. And you see that's a much smaller quantity right there. So that is the import restriction right there. Domestic producer revenue. Let's now look at some of these letters. They're going to put the alphabet on here. It looks complicated. It's actually not if you understand what you're doing. So domestic producer revenue. Well, initially they were only selling Q1 units, weren't they? Okay, and they were getting the price of PW. So initially their revenue was just A. Now they're selling still Q1 units, but they're getting a higher price. So they're getting A plus C, so that rectangle there. But also they're getting the difference between Q3 and Q4, and again they're getting PW plus Q. So they're getting A plus E, that revenue from selling Q1 units over there at a higher price, but also selling at a higher price still, Q3, Q4 units gives them C, H and I, so that rectangle there. So producer revenue, domestic producer revenue has increased substantially. Okay, so it was previously just A, now it's A plus E plus C plus H plus I. So substantial increase in domestic producer revenue. What about foreign producer revenue? Well, before they were importing, well, not they were actually selling, but domestically there were imports coming in from these foreign producers of Q1, Q2, and they were coming at the price of PW. So before the quota, B, C and D represented the foreign producer revenue, but now what's happened? They're only importing Q1, Q3, but they're getting a higher price of PW plus quota. So from B, C and D to now B, F and G. Okay, quantity times the price they're getting. Okay, so it's hard to know what's happened to revenue. We need actual figures to work that out. Okay, so we'll put a question mark. But what we can say is that it's gone from B plus C plus D to now B plus F plus G. Okay, whether that's an increase or a decrease in revenue depends on the figures on the axis here. And in my last video, I talked about the deadweight losses. The deadweight losses are I and J, where J is the deadweight welfare loss of consumer surplus. I is a deadweight welfare loss in terms of a loss of world efficiency, because domestic suppliers are producing units that they shouldn't be at a higher cost or they're less efficient. They don't have the comparative advantage, but they're still supplying those units because of the artificial increase in price that comes from this quota. That's all you need, guys, for this. Okay, so again, when it comes to analysis, you've got the understanding of the diagram, the impact on P's and Q's, the effect it has on revenue, and the deadweight losses right here. You're set for an essay to do very well. Thanks for watching. See you next time with trade subsidies. Hi everybody, let's finish now a little triplet of protectionist policies by looking at a trade subsidy. What is a trade subsidy? It's a subsidy given to domestic suppliers in order to reduce their costs of production and for them to pass that lower cost on via lower prices, which makes it easier for these producers to compete with worldwide firms and therefore to export their products more easily. So again, it's a very sneaky form of protectionism, this one. Something that's very hard to prove. So we're going to follow the same pattern. We're going to look at how a subsidy affects the market. We're then going to apply some of the generic arguments for protectionism to this diagram. And then I'm going to make a second video. Next video will be dissecting the diagram in more depth to give you the key analysis points you need to score very highly if you wanted to use this diagram and this theory in your essays. Okay, so a subsidy given to domestic supply. Now you know that when a subsidy is imposed on the market, that it's going to shift the supply curve downwards. Now because it's given to domestic suppliers here, it's going to shift the domestic supply curve downwards. But it's a very tricky diagram to draw. So this is the way I would do it. Start with a given quantity. Now you know that with this subsidy, domestic supply is going to increase, isn't it? It's given to domestic supply, it's going to increase their supply. So I would start with a quantity value, okay, like that, just call it Q3. Then move up and across, okay, so move up to the domestic supply curve, and move across to then the domestic demand curve, and then you can draw your new supply curve. Okay, so parallel shift, like that, we'll call that supply domestic plus the subsidy. And the vertical distance between the two supply curves is the value of the subsidy, numerical value of the subsidy. Right, this new point also tells us the effective price that suppliers are getting. How do we know that? Because that is the vertical distance, isn't it, between the two supply curves. So Q3, they're getting the actual price PW and they're getting a subsidy on top. The value of the subsidy is the vertical distance between the two supply curves, which takes us to PW plus sub. Now crucially, for you guys to understand this, the price in the market does not change. The price in the market is still at PW, but the effective price that domestic suppliers are getting is PW plus sub. How do we know that this subsidy does not actually change the price? Well, let's go from the initial equilibrium, okay? So in the domestic market, if there was no free trade at all, that would be the equilibrium, that black dot, and that would give us a price, okay? We can call this price if we really want to, call it P1. The value of the subsidy is the vertical distance, isn't it, between the two supply curves, so this black line there. Alright, so the actual value of the subsidy, in terms of the effect it has on domestic price, will only take us down here. And you see that's not below the... Hi everybody, with exams everybody, let's in this video introduce the idea of financial markets and understand why they exist. You need to know this definition. Financial markets are any place where buyers and sellers meet to trade financial assets. But it's much easier to understand the role of financial markets using a visual example here. So we have financial markets in the middle. The primary role of financial markets is to bring together two very important types of people. Lenders, i.e. those that are sitting on excess cash, those that have money, to bring those guys together with borrowers, those that need cash right now but don't currently have it. So what do we mean by lenders? What kinds of people are lenders? Well, savers, for example, and investors. Those guys who are sitting on huge excess cash reserves, and borrowers, for example, individuals who want to buy a house, who want to buy a car, but don't quite have the money right now to finance those transactions. You've got firms who want to invest and grow their business, but they don't have the retained profits right now to do so on their own. You've got governments who maybe don't have the tax revenues right now to finance important expenditures like healthcare, like education, like infrastructure, like welfare. So these guys need cash now, but don't currently have it, whereas these guys are sitting on excess cash and want to lend it out in a return on it. Clearly, the two can meet each other, but it's very difficult for lenders on their own to hunt down borrowers. It's very difficult for borrowers on their own to hunt down lenders, and that's where financial markets come in, whereby lenders and borrowers can get together, lenders can lend, borrowers can borrow through financial markets. That is the role of financial markets, to bring these two groups of people together. Now, lenders can go directly to bond markets, to stock markets, for example. So if we take bond markets, lenders can go directly to the Debt Management Office, that's for the UK, and buy up government bonds, in that sense lending to the government. What else could they do? They could go directly to companies and buy up shares, what's known as equity capital for companies. So they can buy that up, so going directly to a stock market. These are two different examples of financial markets. Or lenders can go to an intermediary. These financial intermediaries also make up financial markets, so they're also in this bubble of financial markets. Let's take an example, a commercial bank. Their primary objective is to take funds from lenders, so it's a great place where lenders can keep their money in a deposit, for example, in the bank. A return is then paid on this money. From these savings, loans can be made by commercial banks and lent out to individual and firms who are willing to borrow, right? So mortgages, for example, loans to buy a car, for firms, loans to invest into their business, right? An interest rate is charged on those loans, and the point is that a higher interest rate is charged to these guys than a return is given to the lenders. The commercial bank will make profit, whatever the difference is between the two. So charge a higher interest rate to the borrowers than the rate of return that lenders put into the commercial bank. And that's the primary role of all these intermediaries. They're within this bubble of financial markets, but they offer a lower rate of return to lenders than they charge an interest rate to borrowers and make profit in between. Learn that, right, as the primary objective of all of these intermediaries. They are there to make profit. So commercial banks is one example, investment banks is another. I've covered investment banks in another video in this playlist. Go and watch that if you want more detail as to what investment banks do. You've got pension funds, for example, that will take huge sums of money from individuals looking to save for their retirement. They'll invest it normally in stock markets, and then they'll pay an annuity to pensioners when they reach that pension age. You've got hedge funds and mutual funds. These are institutions that take huge sums of money from lenders, from investors in particular. They will buy huge amounts of debt from it, so debt issued by borrowers. They'll collect interest rates as the payments on all that debt that they're buying up, and will give a rate of return to their investors. Again, the whole point is that the interest rate that they collect will be higher than the rate of return they pay back to the lenders, to the investors. What's the key difference between the two? Hedge funds will engage in much riskier transactions than mutual funds will. So for example, hedge funds will buy up debt in leverage deals, very, very heavy leverage deals, basically much riskier deals than mutual funds. If these go bad, then we're talking huge sums of money that these guys can lose, whereas mutual funds won't engage in such leverage deals, such high risk deals. Mutual funds are not regulated as much as hedge funds are. There's big regulation for hedge funds. So what they both do is a very simple thing, right? They take huge sums of money from investors, buy up lots of debt, get an interest rate back, and then give a return which is less than the interest rate to lenders. But the simple difference, more risky hedge funds, less risky mutual funds. You don't need to know this in huge detail, but you do need to know the basic difference there. You've also got intermediaries like stock exchanges, like insurance companies, the list goes on. There are lots of different types. But these guys also make up financial markets. So now you understand the primary function of financial markets is so simple: to bring together two types of people, those that have excess money and want to return, with those who don't have money right now but want it and are willing to pay an interest rate. Simple as that. Stay tuned for my next video where we look at the big structure of financial markets, which you also need to know in detail. I'll see you all in that video, guys. Thanks for watching.
Det här är Jörgen, prao på sin mammas kusins jobb. Nu har han fått en uppgift.
Hi everybody, let's in this video break down financial markets and look at three types of financial markets that exist in the economy. We've got money markets, capital markets and currency markets. You need to know a bit about all three. Remember what a financial market is. It's any place where buyers and sellers meet to trade financial assets. What kind of assets are we talking about in money markets? Well, the buying and selling of financial assets here are financial assets which have a maturity or a payback date of a year or less. So for example, government bonds or corporate bonds that have a maturity date of a year or less, that are paid back in a year or less, will be traded, bought and sold in the money market. Any interbank lending that's taking place, so if commercial banks are lending to another commercial bank, or a commercial bank is borrowing from another commercial bank, those transactions are often daily and therefore will take place in the money market. So any IOUs, any assets with a payback date of a year or less will take place in money markets. Capital markets is the buying and selling of financial assets which have a payback date of greater than a year, so not quite as liquid as money market transactions and money market assets. At this stage, guys, I want to introduce the difference between debt capital and equity capital. Debt capital is any financial asset which pays back an interest rate, i.e. it's a form of borrowing for the issuer, all right, because an interest rate has to be paid back, whereas equity capital is different to that. If anybody has equity capital, they have a stake in the business, they have a share of the business, and the return is not an interest rate, the return is a dividend, is a share of the profit. So debt capital is a form of borrowing for the issuer, equity capital is not borrowing for the issuer. For the issuer, for debt capital, they pay interest. For equity capital, they pay back a dividend, a share of the profit, all right? So in the capital markets, what kind of debt capital are we talking about here? Well, the buying and selling of government bonds, which has got a maturity date of greater than a year. Whereas for equity capital, we're talking about shares, all right? So these kinds of transactions will take place in capital markets, the buying and selling of longer term government bonds, maybe 3-year, 5-year, 10-year government bonds, and the buying and selling of shares, for example. Right, there are two different types of capital markets. You've got the primary market, the new issue market, where brand new bonds will be issued, for example, through the Debt Management Office in the UK, for example, through an investment bank, for shares as well, or a stock exchange for shares. If there are brand new shares or brand new bonds being issued, then those transactions will take place in the primary capital markets. But these bonds and shares could also be bought and sold. In that sense, they are also highly liquid, easy to convert to cash. Not as liquid as money markets because these are short-term assets, but still highly liquid here because of the important secondary markets, where new bonds and new shares can then be bought and sold again. That will take place in the secondary market, for example, again, through an investment bank or through a stock exchange, for example. So in that sense, all these assets are also quite highly liquid, but crucially, have all got IOUs of greater than a year. We've also got currency markets. There are two different types of currency markets. You've got spot markets, where you can buy currency at the current exchange rate and get it delivered to you right now. And you've also got futures markets, where you can buy currency at the given exchange rate, but that currency is delivered to you at some time in the future. Why on earth would anybody want to engage in futures market transactions? Well, for example, if you're an importer and you're worried about a weak exchange rate in 6 months' time, if you're importing raw materials, when the exchange rate is weaker, that's a higher cost to you. So maybe you're predicting that the exchange rate is going to get weaker in 6 months' time. What you might do is buy your currency now at the current exchange rate, let it get delivered to you in 6 months' time when the currency on the exchange rate weakens, and you're protected against that. Maybe you're a speculator, you're a gambler, and you think you can make money from exchange rate changes. You think that in 6 months' time the exchange rate is going to get stronger. So what you might do is buy your currency now at the current exchange rate, let that get delivered to you in 6 months' time when the exchange rate has got stronger, and sell it, and you've made a big profit in doing so. So the futures market really is there to encourage speculation, for speculators to make a big amount of money. Gamblers, essentially, thinking that they know what's going to happen with the exchange rate, with swings in the exchange rate, trying to make money from it. But also, you know, importers, exporters that are trying to hedge against changes in the exchange rate and protect themselves in that sense. So that covers the 3 different types of financial markets and different kinds of transactions that take place within them. Thank you so much for watching, guys. I'll see you all in the next video. Hi everybody, money can be anything as long as it satisfies these 4 functions. It's got to be accepted as a medium of exchange, and that's really important because the only other option we have is to then barter. And the problem with bartering is, for example, if I need pencils, then I've got to hope that the person who's selling me pencils will accept my board pens. If the person selling me pencils does not accept board pens, that transaction cannot take place. If you have money which both parties accept, then all of a sudden that transaction can take place with money instead. So in a medium of exchange, it's really important. It allows the economy to run, basically. Money has to act as a store of value. It can't deteriorate over time. For example, if you use commodities like fruits, you know, they go bad over time, they lose their value. So as a store of value, money has got to satisfy that function. Now, think about it. Inflation over time can erode the value, it can erode the store of value function of money, whereby £100 maybe in 10 years' time does not have the same intrinsic value to it. So inflation can erode the store of value idea. But the basic idea that if you have £100 in your bank account now, that £100 is still going to be there in 10 years' time, even though the actual value of it might decrease because of inflation, but you can still store money. That's important. Money has got to act as a unit of account or a measure of value. So if you have 2 goods, one good with a price of £10, one good with a price of £25, you know that that good which has got a price of £25 is different in some way to the good that's got a price of £10, right? It gives you that unit of account function. You know that if there are different prices, these goods are different in some way. That's important. And also, money has got to act as a standard of deferred payment. This is really important, whereby people that don't have money right now can borrow it from those that do, meaning that they can pay back that money over time. That's a very useful function, so that people that don't have money now can still buy goods and services, paying back at a later date. So standard of deferred payment, the idea of bringing lenders and borrowers together, very important when it comes to financial markets. What are the characteristics that money has to have? Well, money's got to be acceptable, i.e. act as a medium of exchange. It's got to be portable. Of course, there's no point in having money which is very difficult to carry around. It's got to be easily portable. It's got to be durable, right? That's important. It's got to be divisible, whereby it's easy to actually have it and understand it. It can break down into different units, for example, you know, pence and pounds in the UK context. It's got to be limited in supply, so it keeps its worth. That's important. And it's got to be difficult to forge. It can't be easy to counterfeit, otherwise people will lose faith in money. Something interesting to know is the difference between commodity money and fiat money. Commodity money is any money that's got intrinsic value. Intrinsic value, for example, gold. Whereas fiat money, which is what we use nowadays, notes and coins, has got no intrinsic value whatsoever. So if notes and coins become worthless because of hyperinflation, you can't go and trade in your notes and coins for something else. That's it. That money has lost value. That's fiat money for you. Whereas commodity money has always got some intrinsic value. If you go back 80 years, a lot of countries have what was known as the gold standard, whereby your money, your notes and coins, were backed by gold. So if there was hyperinflation which eroded the value of your notes and coins, you know that you could go to your central bank and trade it in for a certain amount of gold. Nowadays, that idea of commodity money has completely gone. We use fiat money. Notes and coins, we have got pure faith in the value of those notes and coins. If anything eroded the value of it, so hyperinflation or a massive currency crisis, eroded the value of that money, then that's it. Our savings are worthless. The money that we have is simply worthless. We have to start again with whatever new money the government decides to print. That's an important thing to know. We move on to different types of money. Now, money doesn't just have to take the form of notes and coins. It can vary in liquidity, where liquidity is the ease at which money can be converted into cash. Well, if money is cash, that's the most highly liquid it can be, right? So yes, money can be notes and coins, what we know money to be. But money can also come in different types as well, which can complicate the idea of what we know as the money supply, which we'll come on to in a second. But notes and coins, of course, deposits, right? Deposits that individuals have in banks, that firms have in banks, that banks themselves have in the Bank of England, for example. Very, very highly liquid. That can easily be converted into cash. So deposits are also a very important type of money, highly liquid. You've also got something called near money. These are non-cash assets, but can be easily converted into money. So for example, a certificate of deposit, whereby you deposit your money in a bank, but for a fixed period of time. You get an interest rate on that over the period of time that you're keeping it in a bank, so maybe 5 years, but your money can't be taken out of that bank account in that 5-year period unless you pay quite a significant fee to do so. So in that sense, your money isn't as liquid as notes and coins or normal deposits, which can be taken out whenever you want, but it's still very highly liquid, you know. It's going to become money that you can take out in only 5 years. So it's a non-cash asset, but it's still quite highly liquid. Another example of near money are bonds, for example, with maturity dates of 1 year, 3 year, 5 years. You know, these bonds will mature in a short period of time, but you can also buy and sell them, so you can convert them into cash very easily. So not quite as liquid as these two, but still highly liquid, can be easily converted into cash if you need it. That's what we mean by near money. Let's now move on to look at different types of the money supply, what the money supply is. The money supply is just the total amount of money circulating in the economy. A very simple idea, but can get very complex to measure because of all the different types of money that exist, right? In the UK, we can look at things in very narrow terms, where we have something called M0, and that is a measure of the money supply, which includes simply the total amount of notes and coins out there in the economy, but also all the deposits that individuals have in bank accounts. For example, individual savers, for example, banks themselves that have got deposits in the Bank of England, for example, firms that might have deposits in banks as well. Now we know that deposits is basically money, right? You can easily take it out and spend with it. So these two are very, very, very highly liquid forms of money. And that's what will be included in M0. You can see how that's a very narrow measure of the money supply. It's only including these very, very liquid forms of money. And we know there are lots of other types of money that count as well. In the UK, we have things like M1, M2, M3, and M4. And as we move down these different numbers, we are adding more and more non-cash financial assets into our measure of the money supply. Now, these themselves are also highly liquid, but not as liquid as notes and coins and deposits. So the more we move into higher numbers for the money supply, so M1 to M2 to M3, we are adding slightly less liquid non-cash financial assets to the point where we finish with M4, which is a broad way of looking at the money supply. Well, yes, we still have notes and coins and deposits in our measure of the money supply, but we also have non-cash financial assets that can still be quite easily converted into cash included. For example, certificates of deposit. For example, bonds. The Bank of England will say that alongside notes and coins and deposits, also what's included and counts as money in M4 are non-cash financial assets with maturity dates of 5 years or less, i.e. that can be converted into cash in 5 years or less, or that can be bought and sold easily and be converted into cash. So just simply learn the broad measure of money supply, i.e. M4, as notes and coins and deposits, as M0, but also non-cash financial assets that is still highly liquid, i.e. that is still quite easy to convert into cash. Don't overcomplicate the money supply, keep it simple like that. That's it when it comes to money and the money supply. Thank you so much. Stay tuned for the next video where we look at the quantity theory of money and how we can look at the money supply and the link to inflation. I'll see you in that video, guys.
Dofilus, en yoghurt med 3 bakteriekulturer för din mage.
Hi everybody, the quantity theory of money is a theory that links growth rates in the money supply to growth rates in prices, i.e. inflation. It's a theory that's been around for many, many years, hundreds of years, going back to the 16th century, can you believe? But it's a theory that's been reinvigorated in the 20th century by economists like Irving Fisher, but most notably monetarists like Milton Friedman, who said that inflation is always and everywhere a monetary phenomenon. So for monetarists, this is the reason why there is inflation, the primary cause of inflation. And that is because it's a theory that links the money supply to inflation, a direct link between the two. So monetarists say this is the only reason why there is inflation in the economy. They will use the Fisher equation as the premise to explain this link between the money supply and inflation, we need to build to this Fisher equation where MV equals PQ. Let's do so by first understanding the different variables in this equation. M is the money supply, okay? So for example, M4, as we learned in my previous video. V is the velocity of circulation. That is the number of times that money changes hands in the economy. Think of it as the number of transactions that take place with a given amount of money. So let's take a £10 note. Let's say you've got a £10 note. You spend that £10, that generates income for somebody else. They then spend it. That generates income for somebody else. They then spend it, etc., etc. So the number of times that £10 is spent in the economy is V, the velocity of circulation. So the proper definition, the number of times a given amount of money is changing hands in an economy in a year. That's velocity of circulation. P is the average price level. Okay, so the average prices of final goods and services in the economy. That's basically going to be our inflation rate. And Q is the quantity of final goods and services sold in the economy, i.e. real GDP, right? So that's what Q is. That then takes us to this crucial identity, which is the Fisher equation. Now, by definition, MV must equal PQ. Let's understand. The left side of the equation, guys, is the expenditure side of the equation, the consumption side of the equation, where you've got the total amount of money circulating in the economy, i.e. the money supply, multiplied by the number of times that we're using it, the number of transactions taking place with that money supply. That gives us the total amount of spending taking place in the economy, right? That is the expenditure method to get GDP. That is nominal GDP right there, the expenditure method. So that is what we are buying in the economy with the amount of money that's out there. On the right-hand side, we have the value of what's sold in the economy. So the final quantity of goods and services in the economy, that's real GDP, multiplied by the price of them. So the price of them is current prices, okay? So if we take the quantity of goods and services sold in the economy, multiplied by their current prices, we get nominal GDP as well. This is the output method of calculating GDP. By definition, clearly, what is sold must have been bought by somebody. What is bought by people must have been sold by producers. The two clearly have to be equal to each other, and that's the point. It's an identity, guys. It's an identity. No one is questioning that identity. But that is the premise of the link between the money supply and inflation. Let's understand why by going to this equation here. So if we want to use the Fisher equation to isolate the impact on prices, let's change the equation to isolate prices. So I just rearranged the equation to get this. P equals MV divided by Q, and that tells you that there are three variables that could influence average prices in the economy, i.e. inflation. You've got the money supply, you've got the velocity of circulation, and you've got the quantity of final goods and services sold, i.e. real GDP. What monetarists say is that no, it's not three variables that can influence prices. It's only the money supply, because V and Q are fixed, and they prove this by looking at data over time. And they say that, look, take the velocity of circulation. Yes, V can change. So in a recession, for example, there might be less transactions taking place with the same amount of money. All right, so V can decrease in a recession. In a boom, V can increase. But they argue that V will not increase or decrease by enough to influence prices in the economy, the average price level in the economy, i.e. inflation. They say something similar about Q, which is real GDP. They say, look, if you look over time, real GDP is relatively constant. It doesn't change hugely. Look at the UK, for example. Since the 1970s, so let's go back just 50 years as an example here. Real GDP in the UK has always been around 2.5%, 2 to 2.5%. That's our trend rate of growth over a long, long period of time. Yes, there are deviations when we have recessions and booms, absolutely. But again, monetarists will argue that real GDP does not deviate by enough to have the influence of prices that we've seen. They will have data to back that up. So what they say, if we go back to our Fisher equation, is that V is fixed and Q is fixed. They don't change by enough to have an influence on prices based on the data that they've used. That leads us to one very, very simple conclusion, that it's not V and Q that can influence prices, it's only M. So if we take V and Q out, look what's left. The change in prices can only be influenced by changes in the money supply. So if there is an increase in the growth rate of the money supply, monetarists will say, by definition, there will be an increase in inflation given a lag time, they will say. But that is the primary cause of inflation right there. only changes in the money supply can lead to changes in the inflation rate. So you guys learn this as an alternate view of looking at causes of inflation. It's hotly debated though. Keynesians are the ones that will debate it very, very heavily. And they say, whoa, monetarists, just whoa, take a chill pill and relax for 1 second. This assumption that V and Q is fixed is ludicrous, especially the idea of V. How on earth is V fixed? They say. And they say, look, for example, in a recession, there is no way that V is fixed. V can decrease significantly in a recession. There is no way you can argue that it's fixed. And as a result, there might not be this direct link between the money supply and inflation. Here's an example for you. So let's say, look, in a recession, the money supply can increase so much, but there might be a liquidity trap where that increase in the money supply is not filtering through to the rest of the economy. It's being hoarded, maybe by banks, for example. They're not lending it out. And that is going to reduce significantly the quantity of transactions taking place, i.e. the velocity of circulation, the number of transactions taking place, will drop significantly, whereby that increase in the money supply is not going to feed through to an increase in the inflation rate. So Keynesians will say in a recession this theory doesn't hold at all, where big increases in the money supply do not feed through to higher inflation rates. That's the debate, and that's why this has not come through to the mainstream, whereby this is the accepted theory of inflation, because there is still hot debates about it, lots of controversy about it. If you guys go on and study economics at university, you can maybe research this in more detail and see for yourself if this is the primary cause of inflation. But you guys learn it as an alternate view. Remember, this is an identity, so if ever you need to make calculations using the quantity theory in money, just always make sure that the left side of the equation equals the right side. But now you've got a deeper understanding of why monetarists will say, like Milton Friedman, that inflation is always and everywhere a monetary phenomenon. There is hot debate about it as well. Very interesting stuff. Thank you so much for watching, guys. I'll see you all in the next video. Hi everybody, let's in this video look at the money market in more detail and specifically understand where interest rates come from in the money market. Remember what the money market is. It's where financial assets are bought and sold with IOUs of less than or equal to a year, or maturities of a year or less. So for example, government bonds with maturities of a year or less will be bought and sold in the money market. For example, any interbank lending between commercial banks will take place in the money market. For example, any borrowing needs from the central bank by commercial banks to fulfill their liquidity needs will take place in the money market. These are all money market transactions because they're short-term financial assets with IOUs of a year or less. I've drawn a money market here, where on the y-axis we've got the price of money, which is the interest rate, and on the x-axis we have the quantity of money. The demand curve for money is downward sloping to reflect an inverse relationship between the interest rate and the demand for money, and the quantity demanded for money. Why is that? Well, at lower interest rates, it makes more sense to hold cash because interest rates on less liquid financial assets are very low, right? In which case, holding cash is not really going to hold you back at all. There's no real reason to hold less liquid assets. Holding cash is fair enough, increasing the demand for money. Whereas when interest rates are higher, it makes less sense for you to hold cash, liquid forms of money. Why? Because you could be investing your money in an asset, a less liquid asset, which is giving you a much higher rate of return. So at higher interest rates, it makes less sense for you to hold money. At lower interest rates, it makes more sense to hold money, explaining the relationship between the interest rate and the demand for money there. The supply of money curve is vertical because the central bank controls it. It's fixed by the central bank at one quantity value. We know that the central banks control the money supply, which is why we draw a vertical independent of the interest rate. Where the supply of money curve intersects the demand for money curve, we get the equilibrium interest rate in the money market. So where the supply of money curve 1 hits the demand curve for money, we get an equilibrium interest rate of I1 and an equilibrium quantity of money, which we know is fixed by the central bank, at Q1. So how can interest rates change in the money market? Well, the demand for money can shift, I'm sure you're thinking. Yes, that is true, but more dominating than that is changes in the supply of money, which is fixed by the central bank. The central bank can alter the supply of money and thus change interest rates, and that effect will always dominate changes in the demand for money. In that sense, the interest rate can be altered purely by the central bank. That's how they set monetary policy in order to meet their inflation target, right? So what tools are available to central banks whereby they can change the supply of money and therefore change interest rates? Well, we're going to look at 3. The reserve requirement, which is the amount of money that commercial banks need to keep in the Bank of England by law.
That doesn't yet exist in the UK economy. That's not regulated, whereas in the US it is. The discount rate can change, or the repo rate, or the bank rate as it's called in the UK. That is the rate at which commercial banks borrow from the Bank of England in order to meet their liquidity needs, short term. And you've got open market operations, the buying and selling of government bonds. So let's look at the reserve requirement. How on earth can the central bank alter the money supply by altering the reserve requirement? Well, if they wanted to reduce interest rates, what they could do is reduce the reserve requirement. That means that commercial banks don't need to keep as much money in the Bank of England. This is not yet regulated in the UK. This is all theoretical at the moment. In the US, though, there is a requirement of how much money commercial banks must keep in the central bank. But in the UK, in theory, let's say, by reducing the reserve requirement, commercial banks don't need to keep as much money in the Bank of England. They can keep more of it in the real economy themselves, increasing the money supply and thus reducing interest rates in the money market. Vice versa, the Bank of England could increase the reserve requirement, forcing commercial banks to keep more of their money in the Bank of England, sucking money out of the real economy, reducing the money supply and increasing interest rates. What could happen to the discount rate, or the bank rate as it's more commonly known in the UK? Well, this one is used a lot by the central bank. This is the dominant way of the Bank of England altering interest rates in the money market in order to meet their inflation targets. Well, remember what the bank rate is. It's the rate at which commercial banks need to borrow from the Bank of England. And this is a big, big deal, because on a daily basis, commercial banks will borrow from the Bank of England to meet their liquidity needs, right? If they don't do that, they can borrow from each other. They can borrow in the interbank market. But borrowing from the Bank of England is a big source of short-term finance if banks need it for liquidity purposes. So if the Bank of England decided to reduce the bank rate, the repo rate, or the discount rate, it means that borrowing from the Bank of England is cheaper, which means there is less money being sucked out of the economy, which is increasing the money supply and thus reducing interest rates. Whereas if that bank rate increased, more money is being sucked out of the economy than before, which is reducing the money supply and increasing interest rates as a result of that. So changes in the bank rate is a big way in which interest rates can change in the money market, and that is the dominant way that the Bank of England will alter the money supply and set interest rates in the money market. Now, the central bank can also engage in open market operations. This is the dominant way of changing interest rates in the US. The Federal Reserve will engage in the buying and selling of bonds in order to change the money supply and change the interest rate. So, if the central bank wanted to reduce interest rates, they would need to increase the money supply. And the way they would do that is to buy bonds. When the central bank buys bonds, they're replacing paper with cash, increasing the money supply out there, reducing the interest rate out there. Whereas if the central bank is selling loads of bonds, then let's say commercial banks who are sitting on loads of cash and are replacing that cash with paper, that is taking money out of the money market, out of the economy, thus reducing the supply of the money curve and increasing interest rates. So that explains to you what the money market is all about and where interest rates come from in the money market, very much set by central banks looking to meet their inflation targets. Yes, the demand curve for money can shift and that can alter interest rates, but that's a theoretical idea. In reality, the supply curve of money dominates because of the control the central bank has over it. Thank you so much for watching, guys. Hopefully now you understand the money market and where interest rates come from in the money market, also known as short-term interest rates for this exact reason. I'll see you all in the next video. Hi everybody, let's in this video cover a very important type of financial asset, that is a bond. We'll answer these questions first. What is a bond? A bond is just an IOU. It's a piece of paper that guarantees the holder of the bond two things. Regular interest payments every year is number one, but also getting the value of that bond back when it matures, the face value of the bond back when it matures, i.e. when it's owed back to whoever has it. Who issues the bond and why? Well, there are two major economic agents that will issue bonds. You've got governments who need to raise finance in order to finance their spending in the economy, on infrastructure, on education, on health and welfare. So governments that don't have the tax revenues to fund their spending will need to borrow. Issuing bonds is one way they can do that. Corporations as well, firms who are looking to invest, if they don't have the retained profits to invest, then how else can they gain that finance? They'll need to borrow money, and issuing corporate bonds is one way in which they can do that. So the reason why is simply to raise finance when governments and firms don't actually have that finance available to them right now. They can issue bonds and borrow. Then that begs the question, who on earth will want to buy a bond and why? Well, anybody can buy a bond. An individual can buy a bond, no matter where they're located in the world. They can buy a UK government bond, for example. Firms can buy bonds. Governments can buy bonds from each other. You know, anybody can buy bonds. And the reason why really is twofold. The yield on the bond, the return on the bond, might be better than the return on other financial assets out there in the economy. So that's a very important factor as an investment for somebody. But also because it's safe. You know, take a government bond, for example. Governments are very unlikely to go bankrupt. Yes, there are one or two examples that we can think of, but it's rare for the UK government, for example, to go completely bust and therefore not pay back whatever bonds that they've issued, right? Very rare. And think about most other financial assets. To give you that kind of security is unheard of. So that's, again, why some people might want to buy government bonds, for example, as a safe haven for their money, guaranteeing a certain rate of return, which might be a very lucrative rate of return. Let's go straight to what a bond looks like. What I've drawn here is a UK government bond, and there are 4 things that will be on this piece of paper, on this IOU. You've got the name, and in the UK, the individual name of a government bond is a treasury, but the collective name for government bonds in the UK, gilts. You've got the coupon. The coupon rate is the interest rate that is paid based on the nominal value of the bond annually, but this coupon rate is fixed over the duration of the bond. That coupon rate will not change. So we've put here 5. So that is £5 every year that is going to be paid to whoever holds this bond. So it is actually a percentage rate, but it's a percentage of the nominal value. And if the nominal value is 100, then that's £5 worth of interest paid every year for the duration of the bond. That is fixed. You've got the maturity, and that will be a year. That's basically when the bond expires. That's when the government has to pay back this bond. Crucially, when the government pays back the bond, they pay back the nominal value of the bond. So upon maturity, the holder of the bond gets the nominal value back. I've said 2022, that's assuming that this bond is a 5-year government bond. I'm making this video in 2017. So 2022 is 5 years down the road. That means that this bond is a 5-year government bond. These government bonds can range in maturity. You can have 1-year government bonds, 3-year government bonds, 5-year government bonds, 10-year government bonds, 20, 30, 40-year government bonds, all kinds of different durations. And then you've got the market price of the bond. Remember, if we look at capital markets, you've got primary issue markets and you've got secondary markets. Bonds can be bought and sold, and if they're bought and sold, they'll be bought and sold in the secondary issue markets, at which point the market price of the bond is important. And the market price is simply determined by demand and supply for that bond. When you buy this bond fresh, you buy it at the nominal value, but then if you wanted to sell it, you'd sell it in secondary capital markets, and you would sell it for whatever the market price is, and that is determined by demand and supply. Okay, this nominal value is really important, and it's important that we differentiate now between the nominal value and the market value. You might think, well, this is really confusing. Why is there one price here and another price there? Well, very, very simple understanding is this. When you go and buy a bag of carrots in the supermarket, you know you want to buy 1 kilogram of carrots. But if you go to Asda, you might be being charged a certain price. If you go to Tesco, you might be being charged a different price. But you know that what you're getting, regardless of the price that you're paying, is 1 kilogram bag of carrots. Well, that's exactly what the nominal value is telling us. The nominal value is just telling us what this bond is and what the end worth of this bond is. So if you hold this bond, you have got a piece of paper that is worth £100. That's the nominal value of it. Okay, what you buy it up for might be different, right? The market price might be different to that, but what you're getting is a bond that has a nominal value of £100. That's going to give you £100 back when that bond is matured. That's all the nominal value is there for, really. And that's why the market price can differ. What an investor will want to know if they hold a government bond is what is the yield? What is the rate of return they're getting? And there is a very important equation for the yield that you need to know, and here it is. So the yield on a government bond is equal to the coupon rate of the government bond divided by the market price. Divided by the market price of the bond. Now, of course, upon primary issue, the yield on this government bond is going to be 5, okay, because you pay the nominal value of it, absolutely fine. But we're assuming that somebody's buying this second hand now, and they're paying £115. They would need to go to the yield, the coupon divided by the market price, multiply that by 100, and that will give you a percentage rate of return. So let's do it for this government bond here. If somebody buys this bond up, they'll have to buy it at the market price, which is 115, right? So 115 with a coupon rate of 5. So let's put those two numbers into our equation. So 5 is the coupon rate, the market price is 115, times that by 100, and you'll get a percentage rate of return of 4.35% to 2 decimal places. So that basically is the interest rate on this bond. It is the rate of return on this bond, bearing in mind what's been paid for it. 4.35%, an investor will look at that and think, whoa, given current interest rates out there in the UK economy, 0.25% is the base rate, bear that in mind. This is an incredible rate of return. I want to hold this government bond. That's how they'll make the decision of whether they want to buy this government bond, whether they want to hold this government bond or not. If that rate of return is better than other returns on financial assets in the economy, absolutely 100%. But the yield is what they would calculate, all right? And this is the equation to get the yield, and that's how they'll work out whether they want to hold government bonds or other financial assets in the economy. You need to be able to calculate this yield. This yield is actually a very simple calculation. A better calculation is the yield to maturity. I made another video about government bonds in the fiscal policy context. In that video, I actually calculate the yield to maturity, which is a more realistic yield calculation to work out the real rate of return on a government bond. But for the sake of your exams right now, you don't need to know that calculation, you just need to know the very basic yield calculation. If you want more detail, go and watch that video to get it. Okay, having understood this yield calculation, what we can also work out is the relationship between the market price of a bond and the yield of a government bond. And the relationship is very, very simple. It's inverse. So when the price of a government bond goes up, the yield on that bond is going to go down. Let's understand why. If the price of a government bond goes up, the coupon rate is fixed, right, over the duration of the bond. So you're dividing a fixed number by an ever increasing number, and that's going to give you a smaller number. That's going to give you a smaller yield. Whereas, if the price of a government bond goes down, the yield is going to increase. You're dividing a fixed number by an ever decreasing number, and that's going to give you a higher number at the end, which is your yield. What's important to know now is actually what happens to prices of government bonds and yields of government bonds if the interest rate on them is higher or lower than market interest rates out there. Well, governments will look to set coupon rates to equalize yields or to equalize rates of return on other financial assets in the economy. So right now, if generally, let's say, that financial assets are paying a return of 1%, then governments will look for new issue bonds to set coupons of 1. Unless they're really desperate to borrow. If they're really desperate to borrow, they'll increase that, okay? But as a very simple example, they'll want to equalize the coupon rate with other market rates out there in the economy. But let's say that over time, the coupon rate is actually very lucrative and it gives yields which are significantly high, like this one right now. 4.35% is so much higher than what you can get at the moment in the UK economy. So investors looking at that, or just ordinary individuals who are sitting on cash, will look at the yield on this bond and think, mate, I want this right now, this is incredible. That will increase the demand for these government bonds significantly. What will that do to the market price? It will increase it massively, right? And depress yields. And that will keep happening until the yield on these government bonds will reflect market interest rates out there. Simple demand supply will get yields to equalize. What if the yield was really, really low? Lower than other market rates out there? Well, demand for them would decrease, that will reduce the price of them, and yields will increase to equalize other market interest rates out there. So this is exactly what you need. Hopefully now you understand bonds in real detail, you can calculate yields, you can smash it when it comes to your exam. Thank you so much for watching, guys. I'll see you all in the next video.
Website blocked? No, it's not. NordVPN from $275 a month.
Hi everybody, let's in this video understand a primary function of banks, which is credit creation. How banks can create money out of thin air and increase the money supply just like that, it seems. Very, very interesting concept. A lot of people think this is really quirky. It's not. It's very sustainable. A process known as fractional reserve banking. Right, so we have our bank in the middle there, and we know that one of the key functions of a bank is to bring together savers with borrowers. Savers will deposit money in banks and will gain a rate of return back from banks as a result. Banks will then create loans from those savings and will lend to borrowers and will charge an interest rate to borrowers as a result. The whole idea is that the interest rates charged to borrowers will be greater than the rate of return given to savers. The difference will be the profit that banks make, and we know that their primary objective is to make profit. Great, that's how it works. But let's dig deeper into this process. Let's understand this idea of fractional reserve banking. Well, let's take an individual saver who deposits £100 in the bank. The bank will then decide and make a very careful calculation of how much of that £100 needs to stay in the bank, knowing that the individual saver is unlikely at one time to demand all of their savings back. More likely that individual saver will come and want to withdraw some of that £100 to finance whatever spending in the economy that saver wants to do, but unlikely that £100 will be withdrawn at once. So the bank decides that maybe only £10 of that needs to be left in the bank in case that saver comes and demands some of it. The rest of it can be lent out to borrowers, £90. Borrowers want money to spend in the economy. When they spend, that generates income for somebody else, at which point that £90 can end up back in the bank as a deposit again. All of a sudden, we are increasing the money supply. Where only £100 existed before, we've now got £90 on top, so £190 in the money supply, compared to just £100 before, remembering that deposits form a key part of the money supply. So now £90 are back into the bank will think, okay, only £9 of that I need to keep in the bank, just in case that individual saver comes back and demands some of their savings. The rest can be lent out to individuals, lent out to borrowers who will then buy goods and services, that generates income for somebody else, and eventually that £81 will come back in the form of a deposit in the bank, and that process keeps happening and happening and happening. So you get the idea of how deposits can be turned into loans and then will come back into the bank as a form of deposits. This process continues. What we can actually work out is how much extra money can be created from an initial deposit using an equation called the money multiplier. And the money multiplier equation is this. The money multiplier is 1 over the reserve ratio, or the reserve requirement. In the UK, the reserve ratio is not set by the Bank of England yet. There's no regulation in place at all. But in the US, there is a regulation of how much commercial banks must keep in their banks when deposits are made. And that is 10% in the USA. In the UK, it's not there.